Welcome back. It's time now to take a look at the top business stories. Etisalat eyes African market via infrastructure sharing deal. Mortgage demand picks up while Dubai property prices continue to fall. And OPEC fails to find consensus on oil output. Let's look at the UAE stock markets first. Shares rose, helped by climbing oil prices and speculation among investors that this week's decline was unjustified. The DFM gained 0.3% to close at 1,556 points. Emirates NBD was the top performer today. The UAE's biggest bank by assets climbed to the highest level in more than a month by 2.2%. Emaar Properties gained 1%, Dia Development was up 0.3% and Drake & Skull added 0.1%. Alfirdas Holding was among the top losers with a minus of 4.2%, together with insurance company Takaful Emirate, which lost 5.2%, and Takaful House, which lost 4.4%. Volumes were very low today. Only 81 million shares were traded, valued at 92 million dirhams. And over in the capital, the ADX gained 0.3% to close at 2,703 points. Etisalat rose 0.9%, Qatar Telecom surged 4.9%, and Waha Capital was up 1.5%. Largest loser on the ADX was International Fish Farming Holding Company, which lost 8.8%. And Ras Al Khaimah Cement Company fell 1.2%. 41 million shares were traded, valued at 72 million dirhams. And let's now look at the GCC equity markets. The country's main benchmarks ended mainly higher today. OPEC yesterday failed to reach an agreement to raise crude output quotas, which sent oil prices surging in yesterday's and today's trade. However, many experts say, would the 12-member organization announce a production increase of, let's say, 1.5 million barrels a day, that would only make official what is already being pumped into the oil market. Already, OPEC supplies more oil than its quotas say. To talk about this further, we're now joined by Bruce Powers, Head of Research at Trust Securities. Welcome to the show, Bruce.
Thank you.
Tell me, why is the market so jittery these days?
Well, the market was surprised. There were expectations that a new agreement would be reached on output levels, and it wasn't. At the same time, we had, since there was no agreement, this is the first time this has happened in over 20 years. So that surprised the market as well. At the same time, we had U.S. inventories drop much more than forecast, the biggest drop since December, and 3 times larger than expectations, again highlighting the argument for higher quotas. Now, the implications of all this is that supply is not going to increase while demand continues to increase, therefore continuing to put upward pressure on prices. Now, oil is already up over 25% this year, and there are a number of analysts who are now coming out with higher targets of 130 all the way up to 140 for the next 150, for the next 12 months.
Let's go back to the OPEC members. Now, more than half of the group wants to see rising oil prices or strong, high oil prices, but that can't be in the interest. Imagine an oil importer suffers through these high levels. For an oil exporter like Saudi Arabia, Bahrain, the UAE, that's going to pinch their economies too eventually. What's your take on that?
Right. Well, this is the risk of not raising the quotas, and what the concern is in the market, that the supply will not come into the market. It'll eventually hurt the developed economies, but also hurt the providers of the oil as well. But all the OPEC members don't agree with each other. There are different opinions. The dissenting members yesterday felt that the proposal was too aggressive and that it would drop prices too fast and too far. So that's why they dissented yesterday. Saudi Arabia is one of the countries that wanted to increase output, and they're the country with the greatest extra potential output. So it's possible if prices keep rising that they may bring more oil into production to help dampen the appreciation.
So we'll
have to see. They may not announce this, though. It may just happen anyway.
So, yeah, exactly. They're just going to do as they want to. Good. Right. Wonderful. Thanks, Bruce. Have a good weekend. And now to our top stories. Etisalat is once more attempting to gain access to a foreign market. The UAE telecom operator is looking at an infrastructure sharing deal in Africa with India's mobile giant Bharti Airtel. According to an Indian newspaper, Bharti Airtel CEO said that talks with Etisalat have started. The asset sharing agreement would include mobile phone towers and fiber networks in Africa. Bharti Airtel already has a strong footing on the continent. The Indian company has access to 16 countries in Africa through a $9 billion purchase of assets from Kuwaiti firm Zain. HSBC is making it easier for home buyers to get loans in Dubai, and while mortgage demand picks up, home prices continue to fall. HSBC reduced interest rates on 25-year mortgages by 76 basis points to now 5.49% and lowered its down payment requirements, James Pearson, the bank's head of assets and liabilities, told Bloomberg. This has caused demand for mortgages to rise this year, he said. While demand picks up, Dubai property prices continue to fall, according to a report by Deutsche Bank. Home values declined 1.2% in May compared with the previous month, and rents fell by 1%, while apartment prices slid 1.3% and villas declined 1%. And in our fast financial news, Dubai-based Noor Islamic Bank may break even ahead of target this year, according to the bank's CEO. He also said the company will look at merger and acquisitions to expand overseas. Noor Islamic Bank posted a profit of 58 million dirhams in the first 4 months of the year. The UAE authorities will not step in to stop a decline in cement prices, according to the Ministry of Economy. Officials say that the prices must be determined by the market and that an intervention would only be carried out if there were manipulations or illegal practices in the market. And after the break, we will run you through what's making the headlines in international business today.